on an issue which is very, I would say, topical, and also it might be of some interest to the students and the faculties who might, think about it, and they might take it up as, a research topic. They might take it up as a, you know, topic to be taught in the class. And so what we are trying to do here is a very simple, I mean, this whatever I'm going to present is it's a very simple way to look at certain interesting questions. And also we'll be using very simple, methods, which I think should be, easy for everyone to understand, whether it's students, and of course it is easy for the faculties, definitely. And since at IIFT, we are majorly working on trade, because that's our mandate, which is given by the Government of India. We are under the Ministry of Commerce, and from time to time, we are giving advice to the government. They are also giving us projects through which also our understanding about how the economy works and how the trade for India is working and how the world is evolving over time, that becomes, I would say, more clearer than it would have been if we had only, looked at, I'm not saying that books are not important. Books are very important. We must first read the books to understand the theories, and then we should look at how these theories should be applied to the data and to the realities, and then again rethink about the existing theories, and that's how the new theories come. So so that is the unique, I think, opportunity we have at IIFT. So, and we naturally exploit that, and then we try to get deeper, try to get deeper insights into this trade that is happening between India and other countries, and of course how in general the trade is evolving around the world. And like very aptly put by Professor Mishra, he gave a very interesting view of the current situation in the world, and he was very right about many of the things he has said in this initial remarks. So let me now come to my topic. So what topic I had chosen is where we have a lot of work where researchers have looked at how trade leads to crisis. So if there is some problem with trade, how that can lead to economic crisis. So which means that if trade is not doing so, if you look at a very simple, I hope the students have done some bit of macroeconomics, microeconomics, international business. So there, if you look at macroeconomics, then a basic macroeconomic identity would be that y is equal to or identical to c plus I plus g plus x minus m, where we are looking at the GDP in the expenditure method as consumption expenditure plus investment expenditure plus government expenditure plus exports minus imports. So in this case, you can see that directly in the determination of the GDP, we have exports and imports. So the link is very clear that if the exports for some reason is not doing well, which might be because of the fact that we lack competitiveness, it might be because of the fact that there is a shock which has happened, an external shock which has happened, because of which it can be an oil price shock, because of which the costs have gone up and we are no more cost competitive, and that's the reason why trade is not doing well. It might be the case that the exchange rate has appreciated. That might be the reason why my exports are not doing well. Also, it might be the case that my competitors are having trade agreements with my destination countries where I want to send my goods and services, and they are getting an access which is at a lower cost than my access of my goods and services. So there I'm impacted. So lots of factors are there which can lead to the slowdown of trade, and from this equation it's very clear that if trade slows down, I mean export slows down, then GDP slows down. So trade leading to crisis is very straightforward. Now, but the question I am addressing is the opposite. How crisis can lead to the reduction in trade. So I am just looking at the opposite spectrum here, where I am looking at how, if there is a crisis, that means if for some reason the economy is not doing well because of a variety of reasons. Here I'll be looking at 3 very interesting episodes in the world economy, and then we'll look at during that time what happened to trade. And that is question number 1. And question number 2 is, does the nature of the crisis affect the way trade is impacted? So the 3 episodes that we are going to talk about is, one is the oil price crisis of the early 1970s. Then we are going to talk about the global financial crisis 2007-8, and then we are going to talk about the COVID crisis after 2019. So these 3 crises, if you look at, they are triggered by very different reasons. Oil price crisis was caused by sudden increase in the price of oil. I'll come to the specific events which led to that, and because of which net oil importing countries were very severely impacted. And because of that, there was an impact on trade, foreign direct investment, GDP growth, and other such macro variables. Similarly, if you look at the 2007-8 crisis, which was triggered by completely different reasons, which originated in US and in the US housing market, and that crisis from US actually spread all over the world through the integration of the capital markets. And that also led to certain impacts on trade and investments. Similarly, if you look at the COVID-19 crisis, that was triggered by a health pandemic, and that led to closure of units, and that led to a crisis, and that also led to the impact on trade. So all these 3 episodes we are looking at, they are triggered by different factors, and then we look at whether these differing triggers have different effect on trade. So that is the second question that we are going to look at, and in that, what we are going to look at is whether the impact differs across product groups. We are going to look at 3 major product groups: agriculture, manufacturing, and services. Also, we are going to look at whether it differs across country groups. So where we are looking at high income countries, middle income countries, and low income countries. Finally, what also we are going to look at is how these different crises affects bilateral trade, that is trade between any 2 countries. So by that, what we are looking at, we are just looking at the problem in a 360-degree manner. So product wise, country wise, and then bilateral trade wise, whether there are any differences. So this is how we are going to look at this, and you will see that very simple data analysis, not much of a complicated things we have done, very simple data analysis gives us interesting conclusions, and which can be further probed into, and which you can, if there are research students, faculties also can further probe, and they can take up future research projects or future research papers can be written on them. And for the students, what is the benefit? Students will get a view about how trade happens and how it is impacted by certain factors, which is I think a very interesting topic to be studied. And also, if later on you are going for jobs or higher studies, these concepts are definitely going to help you. Okay, so from there, now I'm just going to share my PPT. There will be a PPT I'll share, and then slowly we'll go forward and we'll look at what we have in store for this lecture. So let me just share it. Is the PPT visible?
Yes, sir, visible.
Okay, thank you. So, yeah. So the topic is, I've given a name, Trade Impact of Crisis, a tale of 3 episodes. So these 3 episodes, as I've already pointed out, one is the 1972-73 oil price crisis. 2007-8 global financial crisis, and then the 2019 COVID crisis. And we are looking at specifically at the trade impact of the crisis. So this is the plan. We first look at international business, how it has unfolded over the time, and how because of that the world has become more integrated than ever. And then we'll look at what are the links between trade and crisis. So theoretically, what kind of links can be established between trade and crisis? And then we look at these 3 episodes, how they were different, what were the impacts, and then we go into the impact of the crisis on the bilateral trade. We make an India-China comparison in that. So whether India and China, they were impacted differently, and then we come to our conclusion. So that's the plan for today's lecture. So what we are looking at, if you look at India, you will see that actually trading for India is not a new thing. It's a ancient thing, and I think both for India and China. And we can actually trace back international trade to around 3000 BC, when Indian goods were going to Persia, Mesopotamia, Egypt, and parts of Southeast Asia. So even in that time, goods were going from India to these parts, which shows that we had comparative advantage in producing certain goods. And also we had the links, the logistics to send these to these far off places, even during 3000 BC. And what has happened after that is, of course, we had the Industrial Revolution, then we had this ICT revolution. And what this has done is that, and given the discovery of certain routes, this led to a reduction in the cost of doing trade. So whether it is because of lower communication costs, whether it is because of lower transportation costs, the cost of trade did come down, physical trade did come down, and also services trade, which is invisible trade, that also enhanced manifold because of the development of technology and ICT. So that's the reason why the world became more integrated than ever. But in this also there is a role of policy, which we might not have mentioned in this slide. But what is the role of policy here? The role of policy was that after the Second World War, what happened was that it was found by the major countries in the world that because of the 2 world wars, what has happened is the barriers to trade had increased manifold. Why barriers to trade had increased manifold? Because countries were skeptical about each other. Not only that, they wanted to protect their employment, so they were increasing the tariffs so that it becomes difficult for their citizens to trade with each other. Now, I mean, with citizens of other countries. So, if trade is not doing well, naturally the GDP growth of the world was coming down. And that was the time when they felt that there's a need for a new world economic order. So that's how, during the end of 1940s, the 3 important institutions, the World Bank, the IMF, and the GATS was formed. GATS was General Agreement on Trade and Tariffs, which was specifically looking at reducing tariffs, and the World Bank for structural programs, and IMF for stabilization programs. So we cannot ignore the impact of such institutions in shaping the course of the globalization after 1940s. So together with advancement in technology, favorable policy, and this favorable policy, when we are saying, is not only policies which were taken by the countries themselves, but also the policies which are related to flow of goods, services, people, technology, factors across the countries. And these were governed by the World Bank, IMF, and GATS. Till the time we got WTO, which is the World Trade Organization, in 1995, January 1, and that's when the trade laws, international trade laws or international trade provisions that had become legally binding on the signatories. So all these are also playing a role. We cannot ignore that. And so the other vehicle, of course, if you look at the other vehicles through which international trade has progressed, are the multinational organizations, multinational companies who are majorly originating from US, European Union, and Japan. And these companies, they had operations in multiple countries, and they required the policies to be conducive so that it becomes easy for them to move their people, factors, and capital across the globe. So the multinational corporations were the other force which was behind these developments. So that is also one very important thing we should keep in mind. Now, what were the other triggers? Of course, because of all these policies, if you look at the data, then during 1950 to 1970s, the world was growing at a very high rate. There was stable inflation, income of people were growing. So that led to demand for a variety of goods and services. And that's the reason why trade flourished during this time. So income growth is definitely one of the reasons. Lower trade barriers I have already specified, and technological progress also I have already specified. So these are the three very important forces which actually triggered international business, and that's the reason why till 1970s everything was going on very well. But as predicted by many economists, what happened during 1970s was we had accelerating inflation, and that was because of prolonged high expenditure to achieve ambitious employment targets by the various countries. That led to accelerating inflation. Not only that, as we are going to see, because of the oil price shock that happened in 72, 73, because of that, the prices went up, and that led to the formation of flexible exchange rate systems in most of the countries, because the erstwhile fixed exchange rate system based on the Bretton Woods agreement that broke. And because of that, what happened was the net oil importing countries were very severely impacted. And for the first time, world witnessed something called stagflation. So that were the stagflation means the growth of output was decelerating. Along with that, we were having accelerating inflation. So these are majorly triggered by supply side factors, and demand management policies are normally not very effective in such circumstances. They can only solve one part of the problem, but they aggravate the other part. So this was how the things have unfolded during that time. And later on, of course, stabilization policies and changes in the major theories of macroeconomics and trade stabilized the world. But from time to time, we had crises given the triggers. It can be oil price shocks, and it can be some problem with regulation in some of the markets, and which triggers growth in some kind of financial instruments, and that leads to bubble. And when that bubble bursts, then again there's a problem, and that leads to an effect on trade. So this is how and there are ups and downs. Of course, in everybody's life there's ups and downs. So naturally there will be ups and downs in the course of the the countries and the world. Now, if you look at globalization, then globalization has four aspects: economic, cultural, financial, and political. So economic globalization will be where the exchanges between the countries go up. As we have said, it will be in terms of trade, it will be in terms of movement of people, it will be in terms of movement of factors. So given the fact that the countries are engaging with each other, they are signing trade agreements, that leads to economic globalization. Whereas if we look at cultural globalization, then what happens is given the fact that countries are interacting with each other, what happens is the dominant cultures, they uh, transcended the barriers, and they then become dominant cultures in other countries, which might be emulating these countries because of the fact that they are developed countries and they portray themselves as the leaders of the world. So it might be the case that we are blindly aping the culture of the Western countries because we feel that that is one of the ways through which we can become developed. So cultural globalization is a very important aspect of globalization because it leads to harmonization of preferences across the countries. And once harmonization of preferences across the countries happen, it becomes easier for the multinationals to push their goods and services. The third is the financial globalization, where the capital markets integrate. And if the capital markets integrate, it becomes very easy for funds to flow from one part of the globe to the other part of the globe. But the problem with this financial globalization is that they become uncontrollable at the country level. Individual countries are unable to control the flows which are happening across the globe. And then what might happen is, if there is some crisis, it very easily shifts from one country to the other. So that is the problem with financial globalization. Finally, if you look at political globalization, then what happens is that again the political systems, they also tend to become similar, and also what happens is that the countries learn from each other. They learn from each other about their polity, and then there might be situations where a country tries to transform, and just by aping the political system of another country, but it might not be the political system which is very suited for their ground realities. So political globalization also is happening, where major part is also being played by these supranational institutions like WTO and then World Bank, then IMF. They are having policies which are then affecting the the political systems of different countries, because they want the countries to follow a certain kind of policies which they think are good for those countries. So all these things ultimately actually what they're doing is they are integrating the world. They are removing the differences that are there across the world. They are going for more harmonization of standards, harmonization of policies, so that it becomes easy for the multinationals to move their goods and services across the globe. So this is something we must understand, because these are the major forces behind the trade and commerce. So if you look at the farm level, as I've said, that farm level, of course, the production process itself has changed. Now today we have the international production network, which means that if you look at any particular product, it is not originating from one country. Each portion of the product might come from different countries, and then it will be assembled in one country. It may be branded in another country. It may be marketed in another country. So all this has happened because of the fact that it is very easy for us to today transport spare parts from one part of the globe to another part, because of the development of the transportation system and the communication system. So that's why this fragmentation of production has happened, and that has led to very strong multinational companies who in many of the multinational companies can have revenues which are much more than GDPs of many of the poor countries. So that is the strength of the multinational companies that we have. And you can see that this globalization of markets also is telling us that this convergence, as I was telling, that convergence of tastes and preferences across the borders, that also gives them a huge opportunity to sell their goods and services across the globe. So this convergence is happening, and this is being triggered by the strategies that are taken by the multinationals through their branding and marketing campaigns, so that it becomes easy for them to sell their goods and services across the globe. So this is the logic we are giving for firm level decision about why they want to globalize. Now, let us come to the topic trade and crisis. So what is the link between trade and crisis? So if you look at the first point here, the crisis definitely leads to loss of employment and income. So if the crisis happens in an economy which might be triggered by events within the economy or which might be triggered by events from outside, that leads to the impact on production, that leads to an impact on the employment, and of course that will have an impact on the income. Now once it affects income, that causes impact on the demand for goods and services, and also it has a negative impact on the international trade. Why? Because the countries who are net buyers of goods and services, if they are facing lower income, then they are going to buy less, and if they are buying less, then the countries who are selling those products in the international market, their export revenues come down. Also in such instances, what happens is that the protectionist tendencies also go up, because when the country is not doing well, already production has been impacted and employment has been impacted, they will try to erect trade barriers so that whatever little employment they can protect this through this policy. So that is also another problem which we have here. So the protectionist tendencies also go up during such times, and when your country is not doing well, it most likely impacts the currency in such a manner that it depreciates, and if the currency depreciates means the value of the local currency in terms of any foreign currency falls, and when that happens, actually it is good for trade, because then it becomes easier for the it becomes cheaper for the importers to buy those products from those countries. But the problem is that given the decrease in demand, which is triggered by decreasing income in the buyer country, that dominates, and this depreciation in major cases don't help. So this is a kind of, if we look at a very initial way, we can look at the link between trade and crisis. So what questions are we addressing in this talk? So basic questions are these three, as I've already pointed out in my initial remarks. Does the nature of crisis determine the impact on trade? So we'll look at 3 episodes, and we'll look at since they are triggered by different reasons, did they have different impact on trade? Second question, does the impact differ across countries and product groups? So is the impact again different across countries and product groups? And we'll see, yes, it's different. And then we'll look at its impact on the bilateral trade. So these are the 3 episodes we have picked up. So first, oil price crisis 73-74, global financial crisis 7-8, and COVID crisis 2019. And why we have picked, there are many other episodes, but we have picked these 3 because these are triggered by very different reasons. So that gives us I would say a canvas where we can try to find out or try to draw the differences between the impacts of these crises on trade. So if you look at the oil price crisis, why it happened, first it started with in early 1970, President Nixon delinked the value of dollar to gold. Once he did that, what happened was immediately the value of dollar in terms of other currencies came down. So the oil exporting countries who were holding a lot of dollars, the value of those dollars came down. So they were impacted by that, number one. Second, again, what Nixon had done was he had helped the Israel with the arms and ammunitions to fight their war in the Middle East. So this triggered protest from the countries in the Middle East, and the OPEC, the Organization of Petroleum Exporting Countries, they protested that, and the Arab oil ministers, they announced a cut in the production by 25%. Next, what they did was that in December 1973, they raised the price of oil from $5.12 per barrel to 11.65. So what was the impact? If you look at the price of oil measured in US refinery acquisition cost terms, it rose around 500 percentiles. So it's almost 500% growth of the oil price from $2.59 in 73 to $13.06 per barrel in June 1974. So this was the magnitude of the shock. So it's a huge shock that happened, and it was engineered by the OPEC countries. So what was the consequences of that? Worldwide, the growth suffered a severe blow during this first oil price shock. While the world economy was still growing in 1973 at 6.9%, the growth fell to 2.1% in 74 and 1.4% in 1975. So you can see the effect was severe if you look at the 1974 and the 1975. Similarly, worldwide trade also suffered significantly. After the growth rates of 12% in 1973, still it was growing at double digit in 1973, but the growth was negative in the following 2 years. So you can think that the effect on trade was much more than that of output. Here you can see that trade was coming down. So it was minus 5.4% in 1974 and minus 7.3% in 1975. So the effect on trade was very severe. And if you look at FDI, which still grew at 40% in 1973, nearly halved, the growth rate nearly halved in 1974, but by 1976, it was negative, minus 21% compared to the previous year. So you can see that the oil price shock majorly impacted trade and FDI, whereas the impact on output was though high, but better than the trade and FDI. So now let us come to the global financial crisis. So global financial crisis, if we look at the global financial crisis of 2007-8, we will see that it is majorly triggered by the 1997-98 East Asian crisis, which when it got over, the Southeast Asian countries, they had, or basically the East Asian countries, they had a huge surplus of dollars. And what they did was they invested that in the IT sector in US, because US, one, was more safer place, and second, the IT sector was booming. That led to the IT bubble, and in early 2000, the IT bubble bursts, and that led the US to plunge into a recession. In 2001, September 11, there was a September 11 attack. That again gave a body blow to the US economy, and that's the reason why the US government and the US Federal Reserve, their central bank, they went for easy money policy. And this easy money policy led to a boom in the housing market. This boom was basically engineered by giving loans to subprime borrowers, that means borrowers with questionable credit history. And once these subprime borrowers got the loans and they were buying the houses and the housing sector was booming, everything was going well till the point when because of the growth in economies like China and India, the commodity prices in the world went up. US was one of the major importers of commodities from China and India. So naturally, US prices also started going up. To control the inflation, the US central bank or the Federal Reserve, they increased the interest rate. And once they increased the interest rate, it triggered a fall in the asset prices, and that led to the fall in the housing prices, and that led to the fall in the value of the housing. And given the fact that these houses were majorly bought by subprime borrowers, they found that the value of their monthly installments were lower than the value of the house. And so, higher than the value of the house in terms of monthly installments, and so they started defaulting on their loans. Once they started defaulting on their loans, all the investment companies who had bought the mortgage-backed securities, which mortgages were linked to the housing mortgages, their value came down, and that led to a huge financial crisis, which first affected US very poorly, and then it affected the other countries where these investment banks also had exposures. And that led to a worldwide impact, majorly to those countries who were very closely linked with US. And these also had impact on the trade, output and services. And let us look at that. During that time, the world GDP came down by 1.3%. Net FDI inflow as a percentage of GDP reduced by 39%, huge decrease. Trade in goods came down by 23% to 0.5%, and trade in services came down by 10.5%. So you can see that the effect was really severe. All these figures that we are giving is for the world as a whole. Okay, it's for the world as a whole. So it means that the severe contraction of output and trade, both in goods and services and investments. So now, let's come to the COVID. COVID is very well known because all of us have seen COVID. I mean, most of you must have seen COVID. So, COVID was caused by health hazard or a particular, disease which originated in China. And because of the fact that China was the production hub of the world, China had links with many other countries who were shifting their production bases to China. In this case, it was majorly the European countries, and people moved between European countries and China quite frequently, and that led to the spread of the disease. And once the European countries were affected, then it spread through the people who were visiting European countries and then going back to their own countries. That's how it spread across the world. So what happened was, because of the lockdown that happened, it disrupted the production process. That led to loss of jobs or loss of income, and that led to a major drop in the demand. And this was also triggered by the supply bottlenecks, which was caused by the closure of the ports, and also because of closure of certain units and the restrictions that the countries imposed, the governments imposed. So all these triggered the crisis. And if you look at, compared to the other crises that we have discussed here, GDP shrank by 3.3%, trade in goods reduced by 7.5%. The impact on goods were lower than that was the global financial crisis, but here the impact on services was much more. It is 17.4%, and also the FDI inflow as a percentage of GDP reduced by 29%. So you can see that the effect was more or less there for all the three crises. There is a certain differences in the effects, which we will come to next. What were the differences? The differences that we have here is the oil price shock had a minimal impact on GDP growth and trade, though the impact on FDI was very strong, whereas the global financial crisis impacted FDI flows strongly, but its impact on GDP growth was lower than that of COVID pandemic. And trade in goods suffered most during the financial crisis, and we'll try to give the reasons why. And COVID caused massive contraction of GDP, and also its impact on trading services was stronger, because we would expect that because of the COVID, the impact on services should have been lower, because you can, in many of the services, can be provided from the the workplace of the person who is providing the service, and it can be provided to a person who is buying the service in some other country. But we'll see, because there are certain services which requires physical contact between the buyer and the seller, that contracted hugely. That is the reason why the services trade was hugely impacted during COVID. So we are going to look at now the differences. That means why, what are the factors which cause the differences in the impact. So if you look at what happens because of the oil price shock, the oil price shock majorly causes the domestic prices in the net importing country to go up. And this makes their goods less competitive both in the domestic and international markets. But this also leads to depreciation of the currency. So the overall impact on the demand for goods and services from this country will be little bit less impacted. And this of course is not the case for exporting country, because of the fact that all, in this case the exporting country, the oil exporting country, their income is going, so their trade shouldn't suffer much. But then it might suffer because the countries to whom they are selling, their income has come down. If that is the case, then their trade will also suffer. But overall, there will be a balancing force, so the impact on trade may be less. FDI suffers during this time because of uncertainty going up, because FDI means a much higher level of engagement between two economies. So the companies who are looking at FDI, they will be more skeptical about the destination country if the uncertainty goes up. That's the reason why they may postpone their decision to go for investments, and that might lead to reduction in FDI. So if you look at during the global financial crisis, why trade in goods was most impacted, what was found out was that it is because of these financial frictions which go up during a financial crisis, and that affects things like trade credit, which is very much used by traders for international trade. That dries up, and that has an impact on the export of goods. And also, if we are dealing in differentiated goods, it means that goods which are technology intensive or value added goods, these goods have a higher correlation with instability of the output. That means if the instability of the output goes up, which means that there is a fluctuation in the GDP growth in other destination countries, then that affects the demand for such goods hugely. So that is the second reason why the goods were more affected during the global financial crisis. And why the services exports were most impacted during the COVID-19? The reason is that because of the COVID-19, shopping opportunities came down. That decreased the demand, number one. The decrease in sales also was due to the workplace closures, and also may have reduced the earnings of the people, and that decreased the aggregate demand. Whereas some goods demand increased during the COVID-19, like which goods? Demand for food, medical products, personal protective equipments like masks and sanitary products, and also the goods which are used by the people to provide services from their home, like laptops and computers. But the closure of workplaces halted the business operations, leading to suspension of production activities. Also, because of social distancing and other measures, the productivity came down. So all these things were causing problems. Also, that there were labor shortages and lower income, so that might have caused the reduction in services exports and imports. Also, travelers, because in certain modes in services trade, like where we are providing, like let's say education, where the faculty or the student has to go to the university to get their do their courses, that is very severely affected. Or the patient has to go to the hospital to get the operation done, that is severely affected. So mode to travel was severely affected. And also mode 4, where physically the service providers goes to the service buyer's country and provides the service, this was very severely affected during that time. And financial sector was also very severely affected during that time. So that caused the services trade to come down severely during COVID compared to the global financial crisis or the oil price crisis. And also, of course, FDI becomes more costlier. Why? Because the foreign direct investment becomes more costlier because the host countries, one thing is that their demand comes down because of income coming down. So if the FDI is market seeking, then that is impacted, number one. And also the fixed cost of investment, that is searching for a location, getting appropriate workers, that becomes very difficult during a pandemic. So that was causing the FDI to come down during the COVID-19. Okay, so that is so what we have till now discussed is what is the link between trade and crisis, and what are the impacts of the crisis on trade and FDI, and then what are the likely reasons for those effects. And now what we are looking at, our first objective was to look at how the major product groups, their exports were affected during the 3 episodes. And if you see that from this slide, we are looking at the 3 major product groups: agriculture, manufacturing, and services. So if you look at that, then you will see that agriculture majorly affected during COVID, during the global financial crisis, not much affected during oil price crisis, affected but not in the negative region during the COVID-19. Whereas if you look at manufacturing, not much affected during the global financial, the oil price crisis. It was severely affected during the global financial crisis. We have explained why. And it was also in the negative region during the pandemic years, the COVID-19. For the services, we don't have data for 1974, so we couldn't calculate it. But then we can see that both during the global financial crisis and during the COVID, it was negatively impacted, and it was more severely impacted during the COVID. And that some reasons for that also we have already given. Now, if we compare the 3 groups of countries, like high income country, less developed countries, and low and middle income countries. So if you look at these 3 groups, very interesting trend is coming up. That is, in the first 2 episodes, that means the oil price crisis and the global financial crisis, if you look at, you will see that both in total exports, in agriculture, manufacturing, services, the high income countries were more impacted. But if you look at the COVID-19 crisis, for all the product groups, it was majorly the low income countries that were impacted. That means the COVID had a more negative impact for all the major product groups, exports, for the less developed countries. So this is just a simple data, if you just simple data calculation is showing us the impact on less developed countries were much more negative during the COVID-19 crisis than the earlier 2 episodes. The earlier 2 episodes were impacting the high income countries more than the less developed countries. So this is, and we'll get into the reasons why that has happened. A little bit later, we'll come to why. And one of the reasons, let me tell you here, was found that these countries were much less equipped to handle a crisis like COVID, which was a health pandemic, and they didn't have the means to tackle such a crisis. Not only that, it was also found that since their links with the multinational companies were less than middle income countries and the high income countries, that also had a negative impact on the low income countries. Now we have just done a very simple gravity model estimation here, where we looked at the bilateral trade between countries, and then we used the gravity model normal, that gravity model, it basically includes the, it's an equation which has come from physics, and it basically shows that the bilateral trade between countries depend on their individual GDPs, and it depends on the distance between the countries. And of course, there are many other factors now that is included to look at the other factors which impact the bilateral trade between countries. So we have done it for the world first, and then we have done it for India and China to look at the impacts of these three crises on world, then on India, and then on China. So this is the simple estimation that we have done, and these are here all the the estimates are according to the standard trade theory that we should find that the GDPs are having positive impact on bilateral trade, distance is having a negative impact on bilateral trade. If the countries have signed regional trading agreements, that affects bilateral trade positively. If the official language is common between the country, that has a positive impact. All these are along the expected lines. All the crisis dummies that we have taken here, all the crisis dummies are having negative impact, which shows that compared to the earlier years, the crisis year is having a negative impact on bilateral trade, which is also expected. And also another thing that we found out was that if we look at the business entry cost, that affects the bilateral trade, as you can see here, positively. So which means that if the business entry cost is higher, then the bilateral trade is higher, which is of course not very difficult to understand, because business entry costs are more important for foreign direct investments. So if business entry costs are higher, naturally the companies will not go for foreign direct investment, but they will go for more trade. So that's the reason we are getting a positive sign. So more or less on expected lines. Now, if you look at India versus China, this side is India and this side is China. We are also getting similar things, only the magnitude of the impact is different, and that we are going to discuss in the next slide. But if you just look at it, more or less, the results that we have found for world, similar results we are also getting for India and China. Let me just explain the results. So what we are getting is that both the GDPs of India and China are important determinants of their bilateral trade, which means that the domestic economy, the activities that is going on in the domestic economy in both the countries, and the income that is generated from there has significant impact on the GDP of both the countries. One difference that we found was that the destination GDP, that means the country to whom the product is being sent, that GDP has impacted both India and China, but that is more than all other countries, but the impact is more for India. That means the destination level factors are actually more important determinant of India's GDP, but not very much China. So which might be the case because of the fact that China's competitiveness is making them less reliant on the income potential of their partners, whereas India might be somewhat affected by the destination, which means that even if we are having a certain level of competitiveness, but the destination level factors are impacting our trade more, which means that even if we become more competitive, but the destination country has some problems, then that will impact our trade. Whereas for China, that is not the case. So China is also least affected by distance, which shows that their logistics and other infrastructure is helping them more than in case of India. Common language is also another thing which affects China's exports more than that of India. So because of the fact that China, the official language is very different from other countries, so naturally what happens is China is more impacted by of common language than India. There are very few countries where Chinese will be spoken. So those countries, with them, China will have a very high exports. That's the reason we are getting this result. Then regional trading agreements have much lesser role to play for both India. So India and China they are not very much impacted by regional trading agreements, whether they have regional trading agreements with their partners. Because of the fact that if you look at India and China, they are more competitive in many of the sectors than other countries in the world. So they don't require RTS to enhance their trade. In fact, there has been a lot of studies in case of India which has shown that majority of the exporters or importers are not using the RTA route or the preferential route to do trade, because that has certain other costs involved if you are trying to go through that route to get concessions in tariffs while trading with other countries. And business entry costs are also affecting China's exports the least, naturally, because China has a very large diaspora in other countries who are helping to enhance Chinese business potential in those countries. There is a lot of studies which shows that Indian diaspora is not very much effective when compared to Chinese diaspora in advancing business interests of India. Also, crisis impacted bilateral exports from India most during oil crisis and least during the later financial crisis, because financial crisis was mainly happening in US, and that had least impact on India because of our sound macroeconomic policies and also our restrictions on capital account. So, and because we were the net importer of oil, the oil crisis impacted us most. Because of lack of data, we didn't have data on China for 73, 74, or during this 20. Now it might have come. I've done this study a little bit earlier. So because of that, only we are seeing that in 2008, of course, China was more impacted than India. So the global financial crisis affected China more than India. So what are the conclusions we are having here? Across the product groups, both agriculture and manufacturing good exports were more impacted during the global financial crisis. Whereas for services exports, the impact was highest during COVID. Across country groups, high-income countries were more impacted for the first two episodes, whether the less developed countries were more impacted during the pandemic. These results carry through for all categories of the products considered here. All country bilateral trade was simply significantly impacted by the three episodes. And after controlling for the relevant factors, India and China were not impacted, so not much impacted by the episodes per se. But I mean, when compared to the other countries, but China seems to be less impacted by the destination level factors. So these are the major conclusions that I have from this study. And now, if you have any questions, I can take up.
Yes, sir. Thank you, sir. Thank you very much for your insightful lecture. And basically, using certain data and using simple calculation, you have shown how these things are affecting and how that three steps or three decades or three kind of crisis has happened. And interestingly, you just discussed the reverse kind of causality, how that things affecting the economic growth. So basically, that's very much interesting and insightful. Some students have asked some questions. Say if you kindly address it, will be very much helpful for them. And the questions from MA third semester students, they asked how did policies like housing for all contribute to the crisis, and how does protectionism impact international trade during the crisis? So basically, it's considering one development aspect as well as the trade aspect.
Okay, very good question. Just a minute, just have some water. Okay, so the first question is very interesting, and why housing for all can create a crisis. That really happened in US actually, because that was the time when the US government was pressurizing the financial institutions to give loans for building houses, because that was also a part of the policy to go for a expansionary monetary policy. So they were going for an easy money policy, and they thought that if that can create residential property for the people who required it most, but they didn't have the means to do that. So that will, on the one hand, create assets, and on the other hand, also it will increase the flow of credit and money in the system. But it boomeranged. Why? Because of the fact that if you are following a easy money policy for quite some time, your interest rates come down to near zero. Now these people are risky borrowers, subprime borrowers. So you add the premium. Now, if you add the premium also, then also interest rate is not very high. So these people could take the loans. And not only that, teaser loans were given where initially you don't have to pay, let's say for the first 2 years, you are not paying any, you are not paying back the principal, and all sorts of things are done. And because of which the investment in houses went up hugely. So that triggered the increase in the price of the houses. Now, once the price of the houses are going up, it is not a problem. What will happen is it will also then attract investments from other people. Now, what happened was the banks knew that these people are risky. So they shifted the risk to by, converting the mortgages into the mortgage-backed securities, and these were then taken up by the investment banks. Okay. Now, once the investment banks, they continue to invest. Why? Because they were seeing the housing prices are going up. Then if housing prices go up, then the mortgage-backed securities, their prices go up. That is, increasing the profits. So they continue to do that. Now, when triggered by the increase in the interest rate by the, as I've said, the Federal Reserve, triggered by the increase in the interest rate to control the inflation, which was triggered by the growth in India and China, which increased the commodity prices in the world. And US was one of the major buyers, and that led to inflation in US. Once interest rate goes up, then the asset prices fall. And once the asset prices fall, now these people, these are subprime borrowers. So they already have a questionable credit history. They default. And that's how they started defaulting. Once they started defaulting, what happened was that the payment was not coming to the bank, and the bank couldn't send the payment to the investment banks. So that link failed. So the value of the assets held by the investment banks, that quickly came down. And that led to higher debts. That led to the crisis. So this is the issue why housing for all may sometimes not work. Okay. Yeah. And the second question is that about the barrier, that how barriers go up. So actually what happens is that you will see even this whole issue about that US-China trade war. So it was for a long time felt by US that China is artificially keeping their exchange rate undervalued because they are following a kind of a fixed exchange rate system, crawling peg. So they are allowing the exchange rate to fluctuate according to the market conditions very slowly. Now that was giving them an advantage because that is reducing the cost price of the exports. So that was affecting the economy of US because why? They had to buy from China, so they are not producing themselves, so their employment is impacted. Now what happens is that once there is a crisis and a country knows that now the demand for my goods and services will come down, not only from the external world, but also from within my economy. If that happens, that will have a negative impact on employment. So what do? I try to protect my employment by erecting these barriers, trade barriers, so that goods and services don't come to my country. I can restrict them so that little bit of demand is generated for my goods and services, which will keep my employment intact. So that's the reason why during crisis, normally the trade barriers go up.
So for one more question, sir, from PG student, that how much or to what degree does prejudices like country bias, stereotype, harm in influencing international trade between countries?
Well, come again, I didn't. What bias?
Country bias or stereotype. So there are different prejudices which will happen in the trade. How it is affecting the international trade between countries?
Okay, so it might be, see, actually, I will not say that there is much stereotyping or country bias in this case, because ultimately, please try to understand one thing. That means this is the trade is a very special kind of a sector. Why? Because the policies are made by the governments, but trade happens between firms, people, okay, who are actually not directly linked to the policy making. So policies is made at the government level, but the exchange is taking place at the private level. So whether it's companies or people. So normally these biases are all I would say artifact of some political people who try to make us think that this is happening, but it is not. If you today look at, I will just give you a very simple example. If you look at what is our trade with China, today I have just done a study for the government of India on our vulnerability to China. Okay, and we have made an index and we have found out what are the products for which. And if you won't believe, in majority of the products, 90% or more than that input is from China. And I also searched because the government wanted me to give them advice that which other country can I go to. I also searched that whether China is also the major exporter of that product in other countries. In many of them, it is actually China who has almost the 100% share in the world. So I have to see business. Please try to understand one thing. Business will go according to the interest of the business. So all other things that are being said will be by people to further their goals. I don't have any problem with that. So they have their own goals. But always remember that business will follow its own incentives, its own returns. So in that, nobody can come. And that is very apt if you just look at India-China trade. Just look at that. Then you will understand what I'm saying.
Sir, one question related to policy. What are the precautions and steps countries can take to lower the impact of such crises? And the trade policies, if you could suggest some policies there, we're more interested to learn from you.
Yes, very good. That's a very good question, in fact. So, so what this very simple study, what this is showing is that number one, that I must be diversified, sufficiently diversified across country and across products, so that you can see that different crises had different impacts on different product groups. Also, it had different impacts across countries. So if I have a very diversified product basket and also a very diversified country basket, then that will somewhere help me to tide over such crises. If that means some countries are impacted, I can at least export in some other countries, so that helps. Or if some products are affected, I can export some other products which can help. That is number one. Number two is definitely, even if the the estimation shows that RTAs have not very much impacted, but it is positive. If you see, the impact is positive. So definitely regional trading agreements has to be signed with the important trading partners, so that our trade with them doesn't severely come down during the crisis. So one of the ways is definitely through having regional trading agreements. Third, I will say, is that one thing that must be done by the companies and people who are engaged in trade is constantly monitor the world. So you have to constantly monitor the world, constantly monitor the trends, constantly monitor the policies, so that from there you can come up with a doable strategy which will help you to tide over any such crisis. Because what happens is these crises cannot be predicted. Very few cases they can be predicted, because these are kind of, if you ask me, black swan events. So it is very difficult to predict. But then when it is very difficult to predict, that means I will have very less time to react, because once it happens, it is, so I should have a very flexible strategy framework, very flexible strategy framework, so that I will have links with suppliers, I will have links with my buyers, and it has to be very, very diversified, so that once such thing happens, I can very easily, tackle that, and I'm more flexible, so that at least if it is not maximizing my gains, it is minimizing my loss.
Yeah. Sir, if you would like to address one more question, there are many questions, so at least one question. That where does the Asian financial crisis, like Sri Lankan crisis, where the Bangladesh also approaching towards, many economists are saying, so how that Asian financial crisis fit in the context of the global crisis, and how it significant? That kind of question.
Yeah, so I don't think, see, Bangladesh, this is a very important question. Why? Because in trade, how do we analyze situation is that where we are looking at a small country case and a large country case. Okay, so small country case means that it is small country, doesn't mean small in size. Small country means that as a share of the total world trade, your share is less. Okay, so But actually what we mean is that if something is happening to your country, then whether that affects the world. That is the test of whether you are a large country or not. Now, if you look at, then it is only if you ask me, a country like US and European Union as a whole can be designated as a large country. Other than that, all countries are small. Because something happening there, it doesn't have the strength to impact the world economy. But it can have effect on me, because why? If my trade with Bangladesh is very high, because we have done a study for West Bengal, and West Bengal's almost 90% of trade is with Bangladesh. So West Bengal trade will be impacted. That means India's trade will be impacted if now Bangladesh thinks that we'll, instead of trading more with India, we'll trade with China. Then it will impact us. But then if we have a sufficiently, that's what I said, if you have sufficiently diversified basket of commodities and also sufficiently diversified destination countries, then we'll maybe initially will be impacted, but later on we can, we'll be able to come out of it. It's not that we cannot come out of it. But we have a huge trade with Bangladesh. At least exports itself is around $11 billion. So huge trade. And we have a surplus. So it will affect us. But I think Indian government will, that's where the government comes in, and I think they will effectively negotiate and they will do something, because it is not that all products they will be able to buy from China, because there is also a cultural dimension to it. So we are culturally much closer to Bangladesh. So that will little bit, I think, limit the losses.
Fine, sir. If you want to address that, sir, Registrar, sir, I would like to say something. Yeah.
No, you can propose formal thanks. We are indeed grateful for your elaborate deliberation. And sir, you can sense that there are so many questions. We can interact in person sometime where we can spend more time in addressing the queries of students and also understand their line of thinking. So thank you very much for your time. Shobhan, over to you.
Yes, sir. So I'm requesting Sanjay sir to kindly address the vote of thanks. So Sanjay sir, please. Over to you, Sanjay.
Thank you, sir. Good afternoon to all.
Sanjay, it is echoing. I think you can off one mic, or you can connect from Rahul's by mic. Yeah. No, you are not audible. Rahul's.
Good afternoon to all.
I think it's better now. You can go ahead.
I'm Dr. Jitendra Kumar.
No, I'm just saying, Sanjay sir, kindly join with from Rahul sir. Rahul sir system. I think that is connected, so there will be no.
Good afternoon to all. Yes. Yeah. It is an honor and privilege to deliver the vote of thanks for today's insightful lectures organized by Department of Economics, School of Humanities and Social Sciences, JAIN University. First, I extend my sincere thanks to our chairman, Dr. Jitendra Kumar Mishra, JAIN University, for his support, and your vision continue to inspire our academic journey and allows us to hold such meaningful events. I also extend my sincere thanks to Sri Rabindra Bhandari, Vice President, JAIN Group of Institute. My heartfelt appreciation goes to our Vice Chancellor, Dr. Raj Singh, and our Pro-Vice Chancellor, Dr. Dinesh Anilkant, for their constant encouragement and for fostering an environment where learning and dialogue can thrive. A special mention and thanks to our Registrar, Dr. Jitendra Mishra, and Senior Academic Coordinator, Professor Taya Afzal, for their seamless support, ensuring everything runs smoothly. I would like to express our deepest gratitude to Professor Bibek Ray Chaudhury, our esteemed resource person for today. Sir, your lecture was truly enlightening, and your deep understanding of the subject has broadened our perspectives. We are grateful for the time and efforts you have invested in sharing your knowledge with us today. A big thank you to Dr. Sushovan Moiti, convener of this lecture series. I would also like to acknowledge the valuable contribution of all our faculty members who continuously work for the events, and your dedication is the backbone for the successful conducting this lecture. A big thank you to our enthusiastic students and participants for your active participation and keen interest. Your engagement made today's event even more dynamic and successful. Finally, I extend my gratitude to the organizing team, technical staff, and everyone working behind the scenes. Without your hard work and attention to this lecture series, today's event would not have been possible. Once again, a big thank you to Professor Bibek Ray Chaudhury and everyone who made this lecture a successful one. Let us carry forward and learning from today and continue our pursuit of knowledge. Thank you all for being here, and we look forward to more and such enriching session. Thank you all.
Thank you, sir.
Thank you. Thank you, everybody. Thank you, sir.
Thank you. Okay.
With your permission, sir, we can.
Yes, we'll sign off now. Right.
Yeah,
Thank
yeah, I'll
you.
sign
Look
off.
forward to
Right.
meeting you in person, sir.
Okay. Thank you. Thank you.
Right. Thank you, sir. Next time when you plan for Bangalore, just let us know. We'll
Yeah, yeah.
work out. Right, sir.
Okay.
Thank you, sir. Thanks. Bye.